You know there's a financial vehicle you can hold your liquid capital in that currently pays 4 to 6% a year compounding interest, but historically it's paid much higher. And you don't have to pay taxes on these earnings. This account comes with other benefits as well. Your liquid capital has to reside somewhere. Whether or not you know it, you have a choice as to where to hold your liquid capital. You can hold your liquid capital in a financial vehicle labeled Account A, or hold your liquid capital in the financial vehicle labeled Account B. A common place to hold liquid capital is inside Account A, which is a bank account. So you get paid a small fee of nothing to let someone else use your money to make exponential profits. But you can hold your liquid capital in Account B, and it will allow you to leverage other people's money to create tax-free passive cash flow. You can create this tax-free passive cash flow even though you're using your money somewhere else. This financial vehicle allows you to control the banking function in your life. It also gives you long-term care protection, critical care protection, and gives your family a large amount of cash when you die. Now, Wall Street has labeled this financial vehicle a bad place to put your money, yet corporations put hundreds of billions of dollars into this financial vehicle. Although it was never intended to be an investment, its historical performance compares favorably with other investments, and it's immune to market losses. And when structured properly, you don't pay taxes on these returns. Now, these are the historical returns of one of the companies we use. These are real rate of returns. They're not average rate of return, which means you capture the value every year and you never lose money due to market losses. It means your money just keeps growing and growing and growing. And what you'll notice is in times of higher interest, this financial vehicle typically pays higher returns. If you look at 2008, as the market lost nearly 40%, this financial company paid a return of over 7%. Not only does Wall Street put hundreds of billions of dollars into this financial vehicle, so do banks. And although historical performances compare favorably with other investments, the role of this account is to act as a holding account for your working capital. Banks put hundreds of billions of dollars into high cash value permanent life insurance. It's called BOLI, bank-owned life insurance. The top 5 banks alone have over $73 billion in life insurance assets. Why do banks put so much money in? Because of the safety, the tax benefits, and predictable growth. They use the cash flow from these policies to pay for expenses such as employee benefits and retirement plans. This isn't a new phenomenon. This has been going on for nearly 200 years. You just don't know about it. And whose money are they putting into these life insurance policies? It's your money. You may balk at the idea of putting your money into one of these policies, but the banks are already doing it. And they're reaping the rewards. They're making all the money. You can cut out the middleman and make the money for you and your family. So here's what happens. The banks put your money into life insurance. And when you need money or other people need money, they borrow against the policies and they lend out your money and they charge a premium for it. They make massive profits for lending you and other people your money. Now the bank makes money in 2 places at the same time with the same dollar, and it's your dollar. They make money inside the policy through the interest and dividend payments from the life insurance company, and they make money from the interest you're paying them. Now, shouldn't we mimic what the banks are doing and make money in 2 places at the same time with the same dollar? Instead of thinking about life insurance as an expense, think of it as an investment for the future. You're always going to get your money back. And yes, there are some upfront costs, but the benefits and the future benefits outweigh the cost. You receive benefits to help pay for bills in case you need long-term care or critical care. You earn uninterrupted compounding growth, so your money continues to grow and grow and grow forever. You get tax-free use of the money. And of course, your heirs get a death benefit, a tax-free death benefit. But let's look at what a policy actually looks like. This is an illustration of a 45-year-old healthy male. If you don't have $100,000 a year you can put into it, that's okay. I've got some other examples. We've got the total premium, which is your yearly deposit. Next column is dividend. This is showing how much dividend the policy is paying back to you every year. So we look at year 10, it's paying almost $34,000. We look at year 15, it's paying almost $60,000. Year 20, almost $96,000. This is passive cash flow. Then we have the premium outlay. That's the total amount of money you're depositing every year. This includes paying back for any loans that you may have taken. And then we've got cumulative premium outlay, which is the total amount you put in. And there's the cash value. So the cash value is the amount of cash you have available to use as a line of credit and put to work in multiple places at the same time. And what you'll notice is we go to year 11 and 12, you deposit $100,000 and your cash value grows by almost $171,000. We look at year 24 to 25, you deposit $100,000 and your policy grows by almost $324,000. The more money you put in, the more efficient your money becomes. When we design these policies, we try to make years 5 to 7 be what's called a break-even year. This means the total cash value available now exceeds the amount of money you've deposited. And of course, we've got the death benefit. Now, this is an example of a 30-year-old healthy male. On the left is just an example, an illustration of holding money inside of a bank account. On the right is an illustration of holding the same amount of money inside of a properly structured life insurance policy. These examples are for illustrative purposes only, so you can see the tax consequences and the growth difference between accounts. Now, the two advantages that a savings account has over a policy is it's more convenient. You can just go down to an ATM or local branch and grab some cash. And you have access to 100% of the cash from day one. Whereas inside a properly structured life insurance policy, you're going to have access to about 70 to 90% of you from day one. If you look at this policy, the break-even year is between year 5 and 6. We go down to year 10, you put in $6,000, and the policy grows almost $10,000 between year 10 and 11. We go down to years 24, 25. The policy grows almost $20,000. And of course, we've got a death benefit. On this policy, day one, the death benefit is $217,000, and by the age of 70, it's over $1 million. This is an example of a 38-year-old healthy male. We're depositing $25,000 a year over a 30-year time period. After year 30 in the bank account, we've got about $843,000. After year 30 inside the life insurance policy, we've got about $1.5 million. If you look at year 20, it goes from $747 to $808. So this account grows by over $61,000, even though we only put $25,000 into it. And if we look at year 29 to 30, it grows by almost $90,000, even though we only put $25,000 into it. And if we take out money during retirement, we'll get about $2.5 million. And we never risk any money. We had access to this money the whole time, and we don't pay taxes on this money. And of course, we've got the death benefit. Now, what's great about a life insurance policy is it's what's called an and asset. It means you put $1 in, and it's going to work in multiple places at the same time. You can use that cash value for anything you want. You want to go invest in the stock market? Great. If you want to go invest in real estate? Great. If you want to buy a car? Great. It doesn't matter what you use that money for, and that money continues to grow, compounding inside your policy. Ultimately, the features of a properly designed high cash value permanent life insurance policy allows you to build what's called a family bank, and it's often referred to as infinite banking. You can borrow money from the life insurance company in a similar fashion you do a bank. Now, you're not borrowing from your policy, you're borrowing from the life insurance company. And instead of using a car, house, or another asset as collateral, the life insurance company uses a portion of your death benefit as collateral. It acts more like a line of credit than it does a loan, because as soon as you start putting money back into the policy and paying back the loan, that money is available to you to use. There's no credit check. Loan to value on real estate doesn't matter. Your debt to income ratio doesn't matter. You control when and how you pay back the loan. You can't be turned down for a loan. And because you own the banking system, you are making the profits, not another bank. Instead of shifting all your wealth to the banks by sending the loan payments and the interest to them, you're redirecting all of this money back to a pool of money that you own and you control. The reason you don't pay taxes on the earnings is because you're taking that money out as a loan. Yes, you do pay interest when you borrow money. No, you're not paying yourself interest. Although if the bank is charging you a higher interest rate than what the life insurance company does, and you're willing to pay the bank that money, shouldn't you just go ahead and be willing to pay that same amount of money back to a banking system you own and control? You pay back the life insurance company just like you would pay back a bank when you borrow money from a bank. Now, the interest costs are typically at below market, and due to the nature of the simple interest you pay on the borrowed money compared to the compounding interest you earn inside your policy, the growth inside your policy will outpace the borrowing costs. You will create positive arbitrage, and the net effect is you'll create a profit when you borrow money or pay very little interest when you borrow money. Not only that, because you are a policyholder of a mutual company, you are considered an owner. And just like a shareholder of a stock company that gets paid a dividend, you get paid a dividend when the company makes money. You get to use this passive cash flow tax-free. Now, dividends are not guaranteed, but the companies we use have been paying a dividend for 150 to 175 years. That's a pretty good track record. We've been told that we must rely on traditional banks to provide the banking process in our life. This isn't true. Start your family bank as an alternative place to keep your cash and control the banking function in your life. Spend your money throughout your life and create tax-free cash flow to use throughout your life and in retirement. Control the terms of your loans and redirect all the money the banks and credit cards are making off of you back to you and your family.